with Great Rock Real Estate. Thanks for joining me. I'm going to talk about how to value income producing real estate. What prompted me to put this together is we're seeing multifamily residential properties double in value over the last couple of years. A little bit concerning, especially now, well, rents of course have gone up as well, but I don't know that rents have escalated quite as much as the pricing has. So I wanted to talk to that a little bit to make sure that people aren't overpaying for properties. Now, if you're paying all in cash, it's not that big of a deal. Obviously, you're getting a lower rate of return, but you're not leveraged, so you're not potentially in trouble. I'm going to talk about three different methods for evaluating income-producing property, commercial property. The first one is sale comparison analysis, and that is typically done for residential appraisal, where you're comparing one property against the other, maybe adjusting for square footage, garage, no garage, so on and so forth. So that is sometimes used in commercial real estate, most often as a sanity check. So you compare a property to this property, you already evaluated it based on its income, but if you want to give it a sanity check, you might look for other comparable sales in the same area, same size, so on and so forth. Another way is cost to rebuild or replace, minus depreciation, of course. That one is more useful if it's a newer building, typically a standalone building, something along those lines, something that's fairly easy to put a cost to. If you've got any kind of, a special building, historical, anything of that nature, that's pretty much out. And of course, the income evaluation on income-producing properties. Most commercial property is purchased to produce income. There are exceptions, obviously. Some people buy buildings that they will inhabit for their business, etc. In which case, it's not necessarily going to be valued by the income method. Maybe more the sales comparison or the cost to rebuild. First income evaluation we're going to talk about is cap rate, but there's also discounted cash flow, a cash-on-cash return, and debt coverage ratio to keep you out of trouble with the bank. Those are the four that we are going to talk about today. So let's go to cap rate. And the cap rate, here are the formulas, and there's three of them because it's three variables that go into figuring out what the cap rate is, or if you want to determine a market value if you're selling a property. And net operating income, what the net operating income should be, if you know the other two. So CP, or first of all, MV, market value, CP is the cap rate, NOI is the net operating income. With these acronyms, you will find on the internet, other people use different acronyms to represent the same thing. And that's what's important here, is the market value, cap rate, and the net operating income. But in this case, these are the acronyms that we're using. So our cap rate equals our net operating income divided by your market value. Pretty simple, straightforward. We'll get into some actual dollar examples here in a second. I just want to go over the formulas because my guess is you haven't taken this algebra since probably 8th grade or somewhere in that neighborhood. NOI equals your market value times your cap rate. And market value, you can arrive at a market value if you know your NOI, your net operating income, and an average cap rate. Average cap rate for your area and for your type and class of property. That's important because the office is not the same. You're not going to get the same cap rate for office space or industrial space as you do for multifamily. So, good way to get the average cap rate for the area is just talk to a local broker or two, or LoopNet. LoopNet is also a good source. So the first step in finding the cap rate is net operating income. And this is probably one of the most important of all of them because there's a lot of variables that go into it. But the first thing you need to do is your adjusted gross income. You need to adjust that gross income for vacancy and credit loss. Vacancy, pretty simple, straightforward, doesn't require much explanation. Credit loss is anything that you may not collect, any late fees that you may not collect, or rents, period, before it may turn into a vacancy. Take that into account. And then next, you add up all your expenses. So we've got our income, now we need our expenses, taxes, insurance, administrative, maintenance, management, utilities, gas, water, sewer, electric. Now, some of these may or may not figure into your net operating income because sometimes they're passed on to the tenants. So not everybody runs a building the same way. As an example, management. Some people may self-manage, and so that may be in the NOI when you buy it, but you may be planning on managing it yourself, so it won't be in the NOI unless you're taking a salary, which I highly recommend you do. Can't work for free. Anyway, and lastly, of course, trash. And then simply what you do is just subtract the expenses from the income and you have your net operating income. Fairly straightforward, but an important piece of the puzzle. So cap rate continued. Now that we know how to calculate the net operating income and we know the sales price or the market value, we can figure out the cap rate so we can compare different properties. Cap rate is often used as a quick down and dirty comparison tool for different types of properties. Or sorry, not different types, but different properties. These are all multifamily that I pulled off. I believe it was our local MLS. They're all smaller multifamily. I think that there are fourplex. I think this is a fiveplex and a fourplex. But anyway, we have a net operating income of $35,704 on this one, and we have a sales price or market value of $595. These were actually asking prices is what they were, and they were net operating incomes that were reported. So this one has a cap rate of 6%. Now, I've done the division, and obviously it's in decimal form, and I haven't multiplied it by 100 to actually show the 6%. But you can see the decimal would simply go right there. So that's a 6 cap is what we would call that. Now, this one, we move out of town a little bit, but an hour and a half, 2 hours away out of the metropolitan area, and you can see that we've got a very different cap rate, 8.4. And the pictures in this property actually look very good because as the property quality goes down, usually the cap rate will go up, especially if there's deferred maintenance, et cetera, et cetera. But we've got NOI of $19,325 and an asking price of $229, considerably less per door, hence the 8.4 cap rate. And then another unit, I think this was in Arvada, I believe, so still, basically Denver metropolitan area. 42,344 in NOI, asking price was $650, so a 6.5 cap rate. So a quick, easy way to compare them. There's obviously an awful lot more that you would want to drill down and look at, but this will quickly tell you, A, if we've got a problem with the NOI, which quite often there is because it's not properly reported by a seller for one reason or another, or if you think maybe the building is perhaps overpriced, or it might be a deal. So if you know the NRI of a property, you can also solve for what it should sell for based on this approach. So if you are looking to sell, you'll need to know the average cap rate for the property type in your area, and as you can see, area is important. To do this, just use the rate of, or you can also use the rate of return that you would like to see if you're on the buying side, to see if the property falls into what you're looking for, if it fits your investment criteria. So the NOI divided by the cap rate for the area, which we'll see a little bit more on that in the next slide, would equal market value, or what you would be prepared to pay. Because if you're looking for a better return, you're on the buying side, and you're looking for a better return on your investment, then you might want a higher cap rate. And we know what the NOI is, so if we take to a higher cap rate, it's going to give you a lower market value, so you would be looking to pay less than potentially what they're listing it for. So cap rate on a multifamily example. So if you want to buy a multifamily property, we've got NOI of $75,000, nice round number, easy to work with. The local market cap rate is about 5.5%, which is true. Currently, spring of 2016 in the Denver area, and our cap rates have gone down considerably because our prices have gone through the roof in the last couple of years. We were seeing cap rates somewhere around 7%, give or take, and now we're down to about 5.5%. Assuming it's a good property with no deferred maintenance, that's important. It needs to be a property that is a well-oiled machine, very low vacancy, et cetera, et cetera. But anyway, so market cap we've determined is 5.5. So the market value, based on this NOI, this cap is going to be about $1.3 million. Again, assuming it's in great condition, no deferred maintenance. Otherwise, you might use a higher cap rate, like perhaps 7, if it needs boiler repair or HVAC, whatever. Maybe a repiping of getting rid of old copper pipe that's now getting pinholes starting to leak on you, so repiping is pretty serious. So you might want to use a different cap rate there, and you can see down below the difference. 75,000 NOI, a 5.5 cap. The building should sell for about 1.3 million. But if you go to a 7 cap, either because you want a better return on investment or there is some deferred maintenance, you can see that there's almost roughly a $300,000 difference between the two. So cap rate makes a significant difference. So next we'll go on to cash on cash return to evaluate. And again, we've got our acronyms, and this one, IN, is investment, which is your down payment plus any improvements that you're going to do right away. And then the NOI, we've already discussed, DS being debt service, and COC, which is a cash on cash return. So your cash on cash return equals your NOI minus your debt service divided by your investment. So in real numbers, we've got an NOI of 33,600 minus the debt service of 18,242, and we put $100,000 down. So we've got a 15% cash on cash return. Pretty attractive, especially considering what the stock market has been doing the last couple of years. A little bit of a roller coaster, but nevertheless, 15% cash on cash return, pretty solid. If you were to evaluate this, it would look like, and the cap rate, this would probably be a pretty good investment. So debt coverage ratio, this one will keep you out of trouble with the bank, and it is something that the banks look at, because what it basically is the difference or the relationship between what you owe and how much you're bringing in to cover that debt, bringing in as income, rent. Lender, as I said, will also look at this to see if you are over leveraged. So DCR, debt coverage ratio, equals the net operating income divided by the debt service. So in numbers, we've got again that 33,600 as our net operating income, debt service of 18,242, and we're talking about annually here. These are annual numbers. So the DCR, debt coverage ratio, is 1.85, and that's pretty good. 1.85 basically means that you are collecting almost twice as much in rent as it costs you to operate the building. So in effect, if the economy went for a downturn, you could almost cut your rents in half, not quite, but you could almost cut your rents in half and still break even. So a little bit safer, keep you out of trouble. Discounted cash flow. This is pretty extensive, and it's much more involved and requires some spreadsheet work in order to calculate. Now the others that we've talked about, basically you can calculate them in the field with a calculator and a good memory, or maybe just a quick scratch pad to calculate your NOI, because so many things go into the NOI. But otherwise, for the most part, down and dirty, do it in the field, easy enough. But as I said, this does require a spreadsheet. And next slide. Unfortunately, this does not show up very well on this because of the limitations of the display here. But anyway, what it basically is a spreadsheet of columns, and it's by year. So we've got year 1, 2, 3, 4, all the way up to year 10. And what we've got at the top is our projected gross income, PGI. Again, different acronyms mean the same thing. And then, so we've got projected gross income, our vacancy, and then our expected gross income, which is just the projected minus the vacancy. Operating expenses, and then subtract that out, and then we have our NOI. And then our debt service, and then our cash on cash return. This takes it a step further and also calculates taxes. And up here is where you can plug in some assumptions, and income tax bracket is plugged in here, and I believe they have 35% plugged in here, so it's a pretty, run-of-the-mill, maybe a little high, but anyway, depending on your accountant. So actual cash, after taxes is calculated here. We also, at the very bottom, have some more assumptions, and vacancy rate. Vacancy rate is your operating expense ratio, and this is important as well. Your operating expense ratio, the operating expenses should be somewhere between 30 and a maximum of 45% of gross scheduled income. Any more than that, and there's a problem. An old building that's probably going to need some upgrading somewhere, whatever the case may be. And if it's less than 30%, either A, you've got a great building, which is wonderful, or someone's not quite telling the truth. They haven't included some of the things in the expenses, like management. As an example, that's very common. They'll self-manage and they won't include that in their expenses. But in reality, it's a real expense. Whether you put the hours in or someone else does, it's a real expense. Anyway, so that just gives you an idea, a sanity check of where you are, and then the cash-on-cash return. Now, all of these spreadsheets and some other worksheets I make available to you at no cost, and I'll show you in a minute how to get those. But when you have a look at these and you can actually see the numbers, this is a turnaround property. This is a turnaround multifamily. And in year one, we've got 11% vacancy. Huge, especially for this area. We're operating around, again, this is spring of 2016, operating around 5%, 4% vacancy, depending on how big the building is. Smaller buildings, 20 units, something like that, 0%. 0% vacancy. A lot of times we can turn them without ever missing a day's worth of rent. So, wonderful market that we're in currently. But the expenses jump way up. In our operating expenses, first year they're about 40,000, and then they jump up to I think it's 80,000, and then 75,000, and so on. These first, the year 2, 3, and 4, we're doing some pretty major repairs, either repairs or upgrades, and then we see the rent start to climb, and we start out with 120,000 in projected gross income, and by year 10, I think it's 189,000 in projected gross income, and our operating expense has also gone down considerably, and we're in the high 20s. 27% is what it is in year 10. So now, at year 10, we've got a smooth running money machine that we could easily sell at a 5.5 cap because it's very well stabilized. Anyway, wonderful, wonderful spreadsheet. If you're starting to get serious about purchasing a property, you evaluate it the first couple of other ways that we talked about, fast and easy. It's still looking good. You might want to load it into this and start making some assumptions, if it is a turnaround, about some of your operating expenses, and and see what it truly looks like, especially as it goes out over time. Next slide. So the free worksheets that I do have for you, there's 12 total, and the ones in red are fairly extensive, and the ones in black with the black numbers beside them, they're simple, basic, straightforward stuff, like a mortgage payment calculator. There's not a whole lot to it. It's a simple spreadsheet. Same with figuring out the cap rate. Just plug in the numbers, boom, and it's done. But the cash flow pro forma, which is the one we just looked at, quite a bit more in depth, and also the rehab pro forma. That is a very interesting one. You can look at what a turnaround might look like in a, let's say, $1 million value add multifamily property. So you buy it for $1 million, and then let's say you're going to put $800,000 into it, so you've got $1.8 million into it, and you can look at that rehab, break down costs, hard costs, soft costs, even right down to architectural, so on and so forth, permit, etc., and then look at the rate, the rents that you will get, the increase in rents that you will get, and actually look at your return on your investment, and now going to a lower cap rate and increased in rents, you seriously increase the value of that property. So you've got 1 point into it, it may be worth $3 million with an $800,000 renovation, and of course a little bit of sweat equity. But anyway, they're all Excel spreadsheets, they're all fully modifiable. As I said, some are simple, others are a little bit more complicated, and the way to get them is email me. Just email me to receive them, Mike@greatrock1.com, and I'll email them back to you in one nice, neat little package. Also, if you have any questions about anything that I've gone over today or anything else, feel free to email me as well at Mike@greatrock1.com, and I respond same day, almost always. Thank you for watching, and have a great day.